Is the American housing market on the brink of a catastrophic crash? A chilling question that looms among economists and homeowners alike. As we grapple with this uncertainty, we find ourselves immersed in a sea of fears and speculations. Let's dive deep into the history, present, and potential future of the American housing market. The American housing market has a rich history filled with ups and downs. Let's take a moment to journey back in time and examine its captivating trajectory. In the wake of World War II, America experienced a tremendous housing boom. Soldiers returning home from the war were eager to start families and establish domestic lives. The government responded by passing the GI Bill in 1944, offering low-interest, zero-down payment home loans to veterans. This, coupled with the post-war economic boom, resulted in a surge of new homeownership and the birth of the American suburbs. The next major shift came in the 70s with the introduction of adjustable-rate mortgages. These loans, with interest rates that fluctuated with the market, were a double-edged sword. While they initially provided more people with the opportunity to own homes, they also led to increased instability in the housing market. Fast forward to the turn of the millennium, and we see the emergence of subprime lending. This practice involved lending to high-risk borrowers and was fueled by the belief that housing prices would continue to rise indefinitely. Unfortunately, this was not the case. In 2008, the housing bubble burst, triggering the Great Recession. The crash was a result of a combination of risky lending practices, overvaluation of homes, and the bursting of the dot-com bubble. Millions of homeowners were left with properties worth less than their mortgages, leading to waves of foreclosures across the nation. Since then, the housing market has slowly recovered, buoyed by low interest rates and a steady economy. However, the scars of the past still linger, reminding us of the potential volatility of this market. This historical context sets the stage for our current predicament. With a keen understanding of the past, we can better understand the present state of the American housing market and prepare for what the future might hold. Fast forward to today, and we find ourselves in a precarious situation. The American housing market is teetering on a tightrope, with soaring prices on one side and low interest rates on the other. It's a balancing act that has left many economists and potential homeowners scratching their heads. Let's start with the skyrocketing prices. In the past year, the median price of a home in the United States has surged by double digits. Yes, you heard that right, double digits. It's a staggering rise that has left many potential home buyers out in the cold, unable to keep up with the rapid pace of price inflation. But why are prices rising so rapidly? There's a simple answer to that: supply and demand. Right now, there are more buyers than there are homes available. This imbalance has created a seller's market, where homeowners can command top dollar for their properties. Now let's turn to the other side of the coin: low interest rates. In an effort to stimulate the economy during the COVID-19 pandemic, the Federal Reserve slashed interest rates to near zero. This move made borrowing money cheaper than ever before, fueling a buying frenzy in the housing market. But it also created a dangerous precedent. With borrowing so cheap, many people are taking on more debt than they can handle, setting the stage for a potential wave of defaults if interest rates rise. Speaking of COVID-19, the pandemic has had a profound impact on the housing market. The introduction of remote work has led to a mass exodus from cities, with many people seeking larger homes in suburban and rural areas. This shift in demand has only further fueled the rise in home prices. But it's not just the buyers and sellers who are feeling the effects of this volatile market. The rental market is also feeling the squeeze. As home prices rise, so too do rents. This increase in rental costs is putting additional pressure on those who can't afford to buy a home, further widening the wealth gap in our society. And let's not forget the impact on the economy as a whole. The housing market plays a critical role in our economy, affecting everything from construction jobs to consumer spending. A crash in the housing market could have far-reaching implications, potentially triggering a recession. So, what does all this mean? Well, it's clear that the housing market is in a state of flux. The soaring prices, low interest rates, and the impact of COVID-19 have created a perfect storm, setting the stage for a potential housing crash. The question now is, where do we go from here? There are many theories about the future of the housing market. The crystal ball of housing market predictions is as varied as it is fascinating. From the gloomiest forecasts of a housing crash to the more optimistic views of a steady cooling off, each prediction carries with it a unique set of implications. Among the more alarming predictions is the possibility of a housing crash, a scenario that sends shivers down the spines of homeowners and investors alike. Economists who back this prediction argue that the current state of the market, characterized by skyrocketing prices and a severe shortage of homes for sale, is unsustainable. They point to indicators such as the rise in mortgage rates and the growing disparity between home prices and average incomes as signs of an imminent crash. If this prediction holds true, the impact could be devastating, with homeowners potentially seeing their home values plummet and investors losing significant amounts of money. On the other end of the spectrum, some analysts foresee a slow deflation of the housing bubble, a scenario often referred to as a soft landing. Under this prediction, the market will gradually cool off, with home prices slowing their ascent before eventually plateauing. Advocates of this theory argue that the current demand for homes, driven by factors such as low interest rates and demographic trends, will persist for some time. They believe that this sustained demand, coupled with measures to increase housing supply, will prevent a sudden crash and instead lead to a more gradual market adjustment. Then there are those who predict a middle ground scenario where the housing market experiences a moderate correction but avoids a full-blown crash. This theory suggests that while home prices may fall, they won't plummet to the depths seen during the 2008 housing crisis. The reasoning behind this prediction is the belief that the market's fundamentals are stronger now than they were in the run-up to the previous crash. Factors such as stricter lending standards and a more robust economy, they argue, will help cushion the impact of a market downturn. And of course, there are always the wildcard predictions. These range from the possibility of a government intervention to stabilize the market, to the impact of external factors like a major economic recession or a significant shift in immigration patterns. While these predictions are less common, they serve as a reminder of the many variables that can influence the housing market's trajectory. In the end, the future of the housing market remains a subject of intense debate, with each prediction carrying its own set of implications. As we navigate these uncertain times, it's important to keep in mind that the housing market is a complex entity influenced by a multitude of factors both within and beyond our control. Only time will tell which of these predictions will come true. A housing market crash could have far-reaching consequences. Let's delve into the potential impact such an event could have on various sectors of our society. First off, the economy as a whole would take a significant hit. The housing market is like an intricate web that connects many different sectors of the economy. A crash in this market would reverberate across the entire web. Construction companies would slow down or even halt their operations, leading to job losses in that sector. Retailers selling home goods and appliances would see a sharp decline in sales, putting their businesses at risk. The banking sector would also suffer as mortgage defaults rise, and banks are left with properties they can't sell. On a more personal level, homeowners would feel the effects of a housing market crash deeply. Many homeowners view their houses as investments, expecting their value to increase over time. A crash would wipe out this expected gain, leaving some homeowners with properties worth less than what they owe on their mortgages. This situation, known as being underwater, can lead to financial distress and, in some cases, foreclosure. A wave of foreclosures can further depress house prices, creating a vicious cycle. Renters, on the other hand, might initially think they are immune to a housing market crash. After all, they don't own property, so they can't lose value on it. However, the reality is not so simple. If property owners can't cover their mortgage payments, they may raise rents to make ends meet. In other cases, landlords may decide to sell their rental properties to pay off their debts, leaving renters scrambling to find new places to live. Furthermore, a housing market crash can create uncertainty and instability, making it harder for renters to plan for the future. Even the government would not be immune to the effects of a housing market crash. Property taxes, a significant source of revenue for many local governments, would decrease as property values fall. This could lead to cuts in public services, from schools to roads to public safety. On a national level, the government might need to step in to stabilize the economy, as it did during the Great Recession. This could lead to increased government debt and potentially higher taxes in the future. So we see that a housing market crash would have a ripple effect, touching every corner of the economy and society. It would not just affect those who own homes or work in the housing industry. The repercussions would be felt by everyone, from the renter to the retailer, from the construction worker to the government official. It's clear that a housing market crash would not occur in isolation. Its impact would be far-reaching, affecting us all in one way or another. So, how can we prepare for, and potentially prevent, a housing market crash? A question that many of us have been contemplating as we navigate the volatile landscape of the housing market. As individuals, we can start by making sound financial decisions. This includes buying homes within our means, avoiding risky loan products, and maintaining a solid emergency fund. And remember, real estate should not be your only investment. Diversification is key. Businesses, particularly those in the housing sector, also have a role to play. Building affordable housing can alleviate some of the demand pressure on the market. More importantly, financial institutions need to promote responsible lending practices. This means avoiding the kind of subprime lending that led to the 2008 crash. And let's not forget the role of the government. By implementing and enforcing regulations that promote transparency and accountability in the housing market, the government can help prevent another bubble. This includes policies that limit risky lending and speculative buying. But preparedness doesn't stop there. Governments should also plan for the possibility of a crash. This might involve setting up safety nets for those who could lose their homes, or creating economic stimulus packages to revive the housing market if it does crash. Moreover, we need to foster a culture of financial literacy. The more people understand about the housing market, the better equipped they'll be to make informed decisions. This could involve everything from teaching basic financial principles in schools, to hosting community workshops on home ownership. Lastly, it's important to stay informed. Keep an eye on market trends, understand the implications of government policies, and don't be afraid to ask questions. Knowledge is power, after all. In conclusion, the potential for a housing market crash is not something to be taken lightly. But with careful planning and informed decision-making, we can prepare for and potentially prevent such a crisis. Preparedness and prevention are key in dealing with any potential crisis. In conclusion, the future of the American housing market is uncertain. The journey we've taken today, through the annals of history and into the present, has painted a vivid picture of the American housing landscape. We've explored the tumultuous past, a time when housing bubbles grew and burst, leaving trails of financial devastation in their wake. We've revisited the housing market crash of 2008, a disaster that still echoes in the hallways of Wall Street and Main Street alike. Our exploration of the present state of the market has illustrated an unsettling reality. We've seen the factors at play: inflated housing prices, a volatile economy, and the lingering shadows of the past. The American dream of homeownership has become a daunting prospect for many, with affordability increasingly out of reach. We've delved into the realm of predictions and speculations, gazing into the crystal ball of economic forecasts. Some experts predict another crash is looming on the horizon, while others argue that the market is more resilient than we give it credit for. But one thing they all agree on is that the future is uncertain. We've also examined the potential impact of another housing market crash. The ripple effects would be felt far and wide, from individual homeowners to the global economy. It's a sobering thought, but one that we cannot afford to ignore. Finally, we've discussed the importance of preparedness and prevention. We've outlined steps that individuals, communities, and governments can take to mitigate the risks and navigate the potentially stormy seas ahead. From financial literacy to policy reform, there are tools at our disposal to help us weather the storm. While the future is uncertain, knowledge and preparedness can help us navigate whatever comes next.